Something just shifted in the global financial system, and most people are looking in the wrong direction. All eyes are fixed on Washington, waiting for the next signal from the Federal Reserve, yet the real tremor is coming quietly from the other side of the Pacific. Japan has moved, not loudly, not dramatically, but in a way that changes the structure underneath global markets. The Bank of Japan has lifted its benchmark interest rate to levels not seen in decades, and on the surface, the number still looks small, less than 1%, harmless at first glance. But markets do not trade the number, they trade the direction, and the direction has now turned. For more than 30 years, Japan has played a very specific role in the world economy. It was the silent engine of cheap money, the hidden oxygen tube keeping risk assets alive. While the United States and Europe cycled through booms and busts, Japan stayed frozen in time with near-zero rates, abundant liquidity, and a currency designed to stay weak. That arrangement allowed investors everywhere to borrow yen cheaply and push capital into anything that promised yield: stocks, bonds, emerging markets, even the most speculative corners of finance. That era is now under threat. When Tokyo tightens, it does not behave like another central bank hiking rates. It pulls on a single thread that runs through the entire system, and that is why this move matters far more than it seems. This is not about Japan trying to slow its economy. It is about Japan responding to internal pressure. Inflation that no longer looks temporary, wages that are finally rising, households that can no longer absorb a weak currency without pain. Policymakers in Tokyo are facing a trade-off they avoided for decades: protect global liquidity or protect domestic stability. And for the first time in a generation, they are choosing home. That decision forces a reassessment everywhere else, because if Japan stops exporting cheap money, the rest of the world has to relearn how to function without it. The key question is no longer whether Japan will raise rates again. The real question is whether global markets are prepared for what happens when the largest source of free funding begins to shut the valve. To understand why this shift is so dangerous, you have to understand the mechanism it threatens. For 30 years, the global system rested on a simple but powerful trade known as the yen carry trade. The logic was straightforward: borrow in Japan at almost zero cost. Convert that yen into another currency, invest it where yields were higher, the spread became profit. As long as the yen stayed weak or stable, this strategy looked almost risk-free. That is why it exploded in scale. Trillions of dollars flowed through this channel into US Treasury bonds, emerging market debt equities, real estate, and later into technology stocks and digital assets. Japan effectively became the funding backbone of global risk-taking. This was not a fringe strategy used by a few hedge funds. It was embedded into pension funds, insurance companies, banks, and multinational balance sheets. A weak yen was not a side effect. It was the foundation. Japanese exporters benefited because foreign earnings translated into stronger profits at home. Global investors benefited because funding costs stayed absurdly low. Markets adjusted to this reality over decades. Valuations expanded. Leverage increased. Risk tolerance shifted. The world learned to breathe Japanese liquidity without noticing it. But every carry trade has one fatal vulnerability: currency reversal. The moment the funding currency strengthens, the math collapses. Profits evaporate, losses accelerate, positions that looked safe suddenly become toxic. And this is where the danger begins. Because the system is not built to unwind smoothly. It is built to operate under the assumption that the yen remains cheap. When Japan signals that rates are rising and staying higher, that assumption breaks. It forces investors to rethink not just future returns but existing exposure. It changes how risk is priced everywhere at once. This is why even a small rate increase from Japan carries outsized consequences. It threatens the plumbing rather than the facade. And once plumbing cracks, pressure does not leak gently. It releases suddenly and unevenly. What looks like a local policy shift becomes a global stress test. The turning point arrives quietly. Not with panic, but with hesitation. When the Bank of Japan began signaling a more determined stance, markets did not collapse overnight. Instead, they paused. And that pause is where risk accumulates. Currency traders reacted first. The dollar to yen rate swung sharply as expectations reset. That move alone was enough to expose how fragile the carry trade really is. When the yen strengthens even modestly, it eats directly into years of accumulated profit. Investors who borrowed cheaply now face rising funding costs and unfavorable exchange rates at the same time. This is the worst possible combination. The critical detail is not today's rate level, it is the message about tomorrow. Japanese officials have made it clear that inflation is no longer dormant. Wage negotiations are producing real increases. Import costs have hurt households for too long. In this environment, maintaining ultra-loose policy becomes politically costly. That means tightening is not a one-off adjustment, it is a shift in posture. Once that reality sinks in, investors begin to hedge. Then they reduce exposure. Then they exit positions entirely. Each step reinforces the next. What makes this especially dangerous is timing. While Japan tightens, other central banks are slowing or preparing to cut. That compresses yield differentials. The very incentive that powered the carry trade starts to disappear. When the spread shrinks, the risk becomes unjustifiable. At that point, the trade does not unwind because of fear. It unwinds because the equation no longer works. And when equations fail, markets do not negotiate. They liquidate. The deeper problem is that Japan cannot easily reverse course. A return to extreme easing would weaken the yen again and reignite domestic inflation pressure. That path is politically and socially unstable, so the market faces a new reality. The anchor has moved. The funding currency is no longer guaranteed to stay weak, and once that belief breaks, the system must adapt. The next question is where that stress travels first. When pressure builds inside a global financial system, it does not strike the strongest players first. It looks for weak joints. It searches for places where liquidity matters most and confidence matters least. That is why the earliest visible damage from a tightening Japan appears not in Tokyo or New York, but across emerging markets. For years, these economies benefited disproportionately from yen-funded capital. Investors borrowed cheaply in Japan and chased yield wherever it looked attractive. Government bonds in Mexico, corporate debt in Brazil, high-interest instruments in Turkey and Southeast Asia. The logic was simple: high returns plus cheap funding equals easy profit. But that logic only works while funding stays cheap and currencies remain stable. The moment Japan shifts posture, that balance breaks. As funding costs rise and exchange rates move against borrowers, capital becomes impatient. It does not wait for confirmation. It leaves preemptively. That exit shows up first in currency markets. Local currencies weaken, bond yields spike, liquidity thins. What looks like isolated volatility is actually the beginning of a structural unwind. These markets are highly sensitive because they rely on continuous inflows to refinance debt and stabilize prices. When those inflows slow, even slightly, stress compounds quickly. Governments face higher borrowing costs. Central banks burn reserves to defend currencies. Growth expectations fall, and confidence erodes. The most dangerous aspect is speed. Capital can exit far faster than domestic policy can respond. This creates a feedback loop. Currency weakness fuels inflation. Inflation forces tighter policy. Tighter policy slows growth. Slower growth scares investors further. None of this requires a crisis headline. It unfolds quietly through balance sheets. And while emerging markets feel the pain first, they are not the endpoint. They are the signal. Because the same funding that once supported them also flowed into the core of the global system. Beyond emerging markets, the deeper risk lies at the heart of global finance. The US bond market. Japan is not just a source of cheap funding. It is one of the largest holders of foreign assets in the world. Japanese institutions own trillions of dollars in overseas securities, and US Treasuries sit at the center of that portfolio. For decades, this made sense. Domestic yields were negligible, foreign bonds offered better returns, even after accounting for currency hedging. But that calculation is changing. As Japanese yields rise, the incentive to keep capital abroad weakens. At the same time, a stronger yen reduces the value of foreign holdings when converted back home. That creates pressure to repatriate funds. Even modest selling from Japanese investors can have outsized effects. The US Treasury market is deep, but it is not immune. Large-scale selling pushes prices down and yields up. Higher yields ripple outward. Mortgage rates rise. Corporate borrowing costs increase. Equity valuations compress. This is how an external shock tightens U.S. financial conditions without any action from the Federal Reserve. The danger is not an immediate collapse. It is a gradual loss of control. Policymakers in Washington may want to ease conditions, but find markets tightening anyway. That creates a policy dilemma. If the Fed cuts rates, while foreign demand for treasuries weakens, the currency could fall and inflation pressures could reemerge. If it holds rates high, borrowing costs stay elevated and growth slows. Either way, the margin for error narrows. What makes Japan unique is scale. No other creditor holds comparable influence. And because this shift is driven by domestic necessity in Japan, it is not easily negotiated away. This is not a diplomatic dispute. It is a balance sheet decision. When capital decides to go home, it rarely asks permission. It is tempting to imagine this story ending in a single dramatic crash. A sudden sell-off, a week of chaos, a clear bottom. But the more likely scenario is far more uncomfortable. A slow tightening that drains momentum over time. Markets have known for months that Japan might shift policy. That knowledge does not remove the pain. It only spreads it out. As funding costs creep higher and currency risks grow, positions become harder to justify. Investors reduce leverage. They trim exposure. They demand higher premiums. None of this looks catastrophic on its own. Together it changes behavior. Risk assets that thrived on abundant liquidity begin to struggle. Highly valued technology stocks, speculative credit, digital assets, anything that depends on cheap capital feels pressure first. This is how a system deleverages without a headline event. Like oxygen being reduced gradually, the body adapts until it suddenly cannot. The challenge for policymakers and investors alike is timing. There is no clear signal for when to act. Waiting feels rational until it is too late. Acting early feels costly until it looks wise in hindsight. This uncertainty feeds volatility, and volatility discourages investment. Over time, growth slows, not because of a single decision, but because confidence erodes. The most important point is this: Japan is not threatening markets. It is responding to domestic reality. Inflation and wages have changed the political equation. Returning to ultra-loose policy would weaken the yen again and worsen living costs. That option is no longer viable, which means global markets must adapt. They cannot wait for relief from Tokyo. The era of effortless liquidity is ending not with a bang, but with resistance. As risk appetite fades, capital does not disappear. It moves. When leverage becomes uncomfortable and volatility rises, investors look for assets that do not depend on constant refinancing. This is where the flow begins to change character. Gold attracts renewed interest, not because it promises growth, but because it promises survival. Cash regains value because optionality matters again. Defensive assets outperform not through excitement, but through absence of risk. This shift is not ideological. It is mechanical. When funding tightens, assets that relied on cheap money reprice downward, while assets that require no leverage gain relative appeal. What makes this moment unusual is the counterintuitive role Japan plays in it. Tokyo is not trying to shock global markets or undermine the United States. It is responding to pressures at home. Rising prices eroded purchasing power. A weak currency became politically toxic. Wage growth created a mandate to normalize policy. From a domestic perspective, tightening is rational. From a global perspective, it is disruptive. This gap between intent and impact explains why the adjustment feels so destabilizing. The system was built on an assumption that no longer holds. The assumption that Japanese money would always be available at minimal cost. When that assumption breaks, markets must discover a new equilibrium. And discovery is rarely smooth. It forces repricing across asset sectors and regions. The most dangerous mistake now is to frame this as a temporary scare. This is not a rumor-driven sell-off. It is a structural transition. Liquidity is becoming conditional again. Capital is being priced. Risk is being reassessed. The era of effortless carry is fading. What replaces it will be slower, more selective, and less forgiving. That does not mean collapse is inevitable. It means discipline returns. And discipline always feels harsh after abundance. So let us zoom out and pull the threads together. Japan has not fired a single shot yet. It has altered the balance of the global financial system. By shifting policy, it has challenged the foundation of 3 decades of cheap funding. Emerging markets feel the strain first. Bond markets begin to adjust next. Risk assets lose their tailwind. None of this happens overnight. That is what makes it dangerous. Slow tightening erodes confidence quietly. It narrows options. It forces trade-offs. The most important takeaway is not that the United States is about to collapse. It is that the margin for error has shrunk everywhere. For years, markets assumed liquidity would arrive when needed. That assumption is now uncertain, and uncertainty changes behavior faster than fear. The center of gravity has shifted. Watching only the Federal Reserve is no longer enough. Tokyo matters. The yen matters. Japanese bond yields matter. These signals now shape global conditions in ways models built on the last decade cannot fully capture. This is not a prediction of doom. It is a warning about adaptation. Systems that adjust early survive better than those that deny change. The world is entering a phase where capital demands justification again, where leverage must earn its place, where stability comes not from abundance but from resilience. That is the real significance of Japan's move. It is not a headline. It is a regime change. Now the question turns to you. Do you believe markets can absorb this shift without a deeper correction? Or is the unwind still in its early stages? And which assets do you think are most exposed as cheap money fades? Let me know what you think in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.